I helped my client turn their $450,000 non-deductible mortgage into tax-deductible debt without borrowing any extra money, and I'm going to show you exactly how. I'm Jack Chen, Principal Mortgage Advisor at Brilliant Finance Group, and I've been in finance for over 8 years, settled over $450 million in loans, and the strategy we're talking about is called debt recycling. Now, I know the name sounds sketchy, debt recycling. Sounds like something you shouldn't be doing, but it's actually a completely legitimate strategy that lets you convert your non-deductible home loan into tax-deductible investment loans without borrowing any extra money. Let me show you how. But first, let me explain how it works. Think of it like this. Your home loan is what we call bad debt. Not because it's actually bad, but because the interest isn't tax deductible. The ATO won't let you claim on it. Now, if you borrow money to invest in shares or properties that generate income, that interest becomes good debt because the interest on that loan is fully tax deductible. So, debt recycling is simply the process of gradually converting your non-deductible home loan into a deductible investment debt. You're not adding new debt, you're just recycling existing debt for a different purpose. Here's how the loop works. Let's say you've got spare cash. You use that cash to pay down your home loan, then you'd redraw on the exact same amount from your loan and invest it in an income producing asset like an Australian ETFs or shares. Because you use the redrawn funds to invest, that portion of your loan is now tax deductible. The dividends from your investments come back to you. You use those dividends to pay down more of your home loan, then you redraw it again, invest again, and the cycle continues. That's why it's called recycling. If you're using the same loan over and over, but each time it allows you to save some money on that interest portion of the loan. Now, let me show you how it works using one of my clients. Let's call him Tom. Tom owns a property worth $600,000 with a $450,000 mortgage. He's got $80,000 sitting in his offset account that he's been saving for over a few years. Most people in Tom's position would just invest that $80,000 directly into the share market. And that's fine, but they are missing a massive opportunity. So here's what we did instead. Firstly, we split Tom's home loan into two separate loans. Loan A, which is his home loan of $370,000. Loan B, which will be his investment loan of $80,000. Then Tom used the $80,000 in cash from his offset account to pay down loan B to near zero. Next, Tom redraws $80,000 from loan B, invests it in a diversified Australian ETF, which yields approximately 4% in dividends. Because those funds were now explicitly borrowed to invest, the interest on that $80,000 will become fully tax deductible under ATO rules. Let's look at the numbers. If Tom is paying 6% interest, that's $4,800 per year in interest on his $80,000 investment loan. Because it's tax deductible and Tom's in a 37% tax bracket, he saves $1,776 per year in tax straight away. Now, here's where it gets powerful. Tom's ETF portfolio used about 4% in fully franked dividends. Fully franked means that the dividend payments comes with a tax credit for the tax already paid by the company that issued the dividend. In other words, the company has already paid tax on the profits from which the dividend is paid, and Tom can use this tax credit to reduce his own tax liability. So on 80,000, that's 3,200 in dividends plus roughly 1,370 in franking credits. That's a total of $4,570 in tax effective income. Combined with his $1,776 in interest deduction, Tom has about $6,346 in annual tax benefits and income. Tom deposits these dividends into his offset account against loan A, which reduces the interest he's paying on that debt. Then, and here's the key to debt recycling, once he's accumulated enough dividends and savings, he can start this process again by paying down loan A and then redraw the same amount from loan B to reinvest. This progressively converts his non-deductible home loan into deductible investment loan without increasing his total debt. So let's say Tom continues to recycle $10,000 per year over 10 years using this method from a combination of dividends, franking credits, tax savings, and additional cash flow. Assume an average growth of 8% per year. He builds an investment portfolio that could be worth $300,000, having invested a total of $180,000. He hasn't changed the original loan amount, but now $180,000 of it is tax deductible. That means approximately $4,000 in additional annual tax savings. So his investment portfolio is generating passive income and growing. Now, assuming Tom continues with this dividend reinvestment, recycling over another 10 years, with average share market returns of 8% each year and a progressive conversion of debt, in 20 years' time, the 280,000 investment could be worth between 600 and 800,000. He has significantly reduced his bad debt, if any is left over at all, and he would have saved around 80,000 in taxes based on a 37% tax bracket. It's also worth noting that this concept can and is often applied to properties as well. However, they will differ in terms of the returns, cash flow management, and risks. Now, this isn't for everyone. Let me be really clear about who should consider debt recycling and who shouldn't. This strategy works best if you tick these 4 boxes. First, you own your own home and have a home mortgage. This can only work if there is debt to recycle. Second, you have spare cash, either in savings or an offset account, or if you've got access to equity in your property. Third, you have a stable income and comfortable cash flow, and you are okay with a bit of admin and paperwork. And fourth, usually Loan B is set up as an interest-only loan, which means that if you're debt adverse or the thought of holding a mortgage over a long period makes you uncomfortable, this option may not be right for you. There are also 3 main risks you want to consider when deciding whether this strategy works for you. First, investment risks. Shares go up and down. If the market crashes and you need to sell, you could lose money. Second, interest rate risks. If rates rise significantly, your interest rate costs will go up. And third, cash flow risks. Dividends aren't guaranteed and they don't arrive monthly like paychecks. You need to have buffers. Now, if you tick all the boxes and are happy to take on some of the risks, you need to make sure your bank and mortgage brokers set this up properly. The biggest mistake I see people make is poor loan structuring. You need to keep your good debts and bad debts completely separate. That means splitting your loan from day one. Don't mix them. The ATO is very strict about this. If you muddy the waters, you lose the deductibility. You also need to use the funds for investment purposes and not for personal use. A tax audit will require you to show a clean, direct trail of funds from your loan redraw straight to your investment account with no co-mingling of personal and investment funds. So there are 2 ways to execute this. Method 1 is the cash method. If you've got savings, you pay down part of your loan, split the loan, redraw it, and invest. Method 2 is the equity method. If you have worked hard to pay down your debt over time instead of a lump sum, you can access up to 80% of your property value. Take out a separate investment loan and use that to buy assets. The equity method has an added advantage. If you ever convert your home into an investment property later, the loan structure is already clean and ready for full deductibility. So here's the bottom line. Debt recycling lets you turn your non-deductible mortgage into a tax-deductible investment tool without increasing your total debt. But it requires discipline, planning, and proper structuring. If you've got a mortgage, spare cash, or equity, and a long-term mindset, this could be one of the most powerful wealth building strategies you implement. If you've spoken to a financial advisor and a qualified accountant about whether debt recycling works for you and your personal circumstances, and you need help with loan structuring part of it, I have left a link in the description box to book a call. Thanks for watching, and I'll see you in the next one.